Hello and welcome to Shares Spotlight. My name is Mike Boydell. I'm the Managing Director of Shares Magazine. Can I welcome Mark Learmonth? He is the CFO and Director of Caledonia Mining. Mark, welcome to Shares Spotlight.
Thank you for having me.
Could you give us a brief overview of the business and where you operate?
Yeah, we're, as you say, the company is Caledonia Mining. We used to be a Canadian company, but in the last couple of months we've migrated from Canada to Jersey, so we're now a Jersey company, which is very important for UK shareholders because it means the dividend, and we pay a dividend, no longer attracts Canadian withholding tax. So that means as a UK shareholder your dividend's gone up by about a third, which is good. But we didn't just do this for tax reasons, we based ourselves in Jersey for all sorts of other operational reasons as well. Anyway, that's the top company. And our only asset now is we've got a 49% interest in the Blanket gold mine in Zimbabwe. That 49% interest is crucial because it means we're one of I think we're probably the only significant listed mining company in Zimbabwe which complies fully with local ownership requirements. And that's the big bugbear, that's the big scare factor for foreign investors in the Zimbabwean companies is indigenization. So we complied with that in September 2012. So we've been living this deal for several years now, and it's working very well for us. An important factor to understand in the indigenization deal we put together is that although we've only got 49% of the equity, for the next 7 or 8 years we'll collect about 80% of the dividends coming out of the Blanket mine. And at the moment, for the last sort of year, Blanket hasn't paid dividends because, as I think we're going to talk about, it's busy reinvesting in a very significant expenditure, a capital project. But certainly within the next 6 weeks or so, I expect to see those dividend streams starting again from Blanket, building up quite significantly through 2017, 2018, 2019, and then we'll be collecting 80% of that. So don't let the 49% equity ownership sort of cloud your view as to the amount of money we're going to take out of this business. Other thing worth noting is that even though it's 49%, we manage the business. We've got a controlling 49% interest. The other 51% is spread across the local community, the workers, a group of local investors. Government's got 16%. So we actually manage the business. We control the business. We consolidate the business. We get a management fee. And so we just comply with the local owners.
As a business, you're well cashed. You've got $12 million in cash, and you've got an expansion plan of costing about $65 million. But I think you're planning to do that out of cash resources.
Absolutely.
Income.
Yeah. We until recently we had a very significant amount of cash on our balance sheet. I mean, I think a couple of years ago we had sort of $25 million, which for a company of our market capitalization was very large.
Yeah.
Our market cap at the time was probably only about $30 million. So half our market cap would be more than half our market cap was cash. We held that cash because we knew we were going to invest very significantly in the business. We knew that if something went wrong and the gold price fell, and do you know what? The gold price fell, we would have to draw upon our cash resources to make good the shortfall. And so what happened late last year, we'd expected the gold, we'd done our planning on the basis of gold at $1,250. Last year the average gold price was significantly lower than that. And so yes, we had to dip into treasury, we recapitalized Blanket to the tune of $5 million, but that's why we kept the cash. We're now through the worst of the CapEx spend. So last year we spent $19 million. That's the high watermark of our capital expenditure. This year, 2016, we'll spend about $14 million. But crucially, in 2016, as we now start to increase production, we're going to be getting the benefit of selling more ounces. The gold price is helping, so we get selling more ounces at a higher gold price, but our average cost per ounce is now beginning to come down as we're growing the business. So last year, our average all-in sustaining cost was just over $1,000 an ounce. This year, the average will be $820, but as we increase production through the year,
that'll drop further.
It will drop as the year progresses. So the average for the year is $820, starting point's close to 1,000, the ending point will be significantly less than 820.
So 700 something rather.
700 is a bit, pushing it a little bit, more closer to 750.
Yeah.
But what it means is we're now in a more comfortable position than where we were because CapEx lower, cash flow is higher, all of a sudden the sun's coming out.
Perhaps just in a sentence you could perhaps tell our audience why you think that Caledonia is a good investment going forward for somebody who's know the company.
Yeah, we're You don't need to be some crazy gold guy to buy this company. You don't need to expect gold to go to $5,000 an ounce to buy us. Frankly, we're very comfortable because we'll be such a low-cost producer. We will make very good money at the current gold price, perhaps even lower. You buy us because we're growing, we're doubling production. If you look at some research, we've got research available on our website produced by Edison, which is good research. Those of you who are clients of WH Ireland, they produce research, and they show our earnings increasing from about 8 cents in 2015 to 25 cents 2016 to 45 cents 2017 and onwards after that, and that's mirrored by the cash generation. So we're a business that's growing. We'll pay you on the way, we'll pay you a dividend on the way whilst we grow the business. And whilst we are in what is perceived to be a high-risk environment, Zimbabwe is seen to be a high-risk environment, because we've dealt with the indigenization issue, we think that actually we've considerably de-risked ourselves politically. And there are many other places in Africa, South Africa for one, which is where the management team where I used to live, much more challenging to operate. So we're undervalued on a current year basis, 2016 basis, we're on a current PE of 4 and a bit. So we're going to grow the earnings, and we've got scope for a significant re-rating. Both of those could give rise to, I would hope, give rise to a fairly explosive move in the share price. And we're a mature business. We are growing it, but we're not dependent on exploration success. We don't have to construct a new project in the back of beyond, which needs new infrastructure. We're doing this in our back garden. This is a mine we've been running for 10 years. We know exactly what's going on there. So from a mining perspective, it's relatively low risk. Admit that people may have reservations about Zimbabwe. We think Zimbabwe is much understood, and we think our position within Zimbabwe actually flies in the face of the valuation we've got.
Mark, thank you very much. If you'd like to find out more information about Caledonia Mining, please go to the Shares Magazine website. The EPIC code is CMCL.